She is not a legend. She's just someone that has done this for years, mixing economics, finance, and technical analysis. One of our most popular guests. The emails pour in. She's all stochastic. Louise Yamada, Yamada Research. Come on over here. And do you like my new desk?
I think it's
great. It's bigger than my first apartment.
I think it's fabulous.
We're having fun because, like, when we went to break there before, I said listeners. Like on radio, I'm saying viewers, and on TV, I'm saying listeners. It's a complete mess. Anyways, Louise, let's talk about the 30s. Dick Beauvais was all over your great theory of the 1930s. Here's the chart over here. Okay. Yamada looks to the 1930s, and here you are. 1930s, thanks to John Newhouse and Joan for putting this chart together. Where are we now on that chart?
Well, we think that we're probably in the 1939 rally. So the 1939 rally did not get above the 1938 rally. So the question here is whether or not this advance is going to get above the prior to April.
Where is that in Dow points today? Do we need to get above a certain 12,000?
11,205.
I got to do that too with my glasses. It's like this. 11,205 is your key point. That's a headline. When you go back to the 30s, and I say this with all respect for our men and women fighting in these two wars, I think the history books say we got out of that mess because of a substantial war. We don't have another substantial war right now. How are we, in a broader scheme of things, going to get out of this malaise?
I think that we are probably still, although we have yet to see, but we think that we are still in the process of a repair phase of the structural bear market that began in 2000. The repair phase is the phase in which you get cyclical rallies, cyclical bull markets, the way we've been in now, where you're up over 70% with the Dow, you're up over 100% for the transports, and you get cyclical declines, the way we've had over the period of years since.
You know, and we got to stop here, folks. This is important. FedEx did everything they could. We still don't have the official surveillance midday pillow here. I mean, the height differential between you and me.
I've seen that.
You've noticed that.
Yes, I have.
This is we need this official surveillance midday.
I need a phone book.
Maybe if I do this and sort of get down, would that be better? I think that would work out better here. We'll get this figured out.
Right.
Let's talk seriously though. This 30s thing is important. Why does this resonate so much with your clients?
Well, in 2000 we started to try and explain the expectation of a structural bear market because we felt we were moving into one at that point in time. Right. And we looked back and said, okay, we've only had 3 prior experiences of structural bear markets, 66 to 82, you had 29 to 42, and then you had 1905 to 21. Elliott Wave's alternation of cycles suggested that our period from 2000 should be less like the 68 to 82 one, which was inflation and rising rates, and more like the alternate. So we felt there would be some correlations. We had a crash the way there was in 1929. Unfortunately, we had a second decline in 2009, so it's been a little bit different.
But what do you think for 2011? I mean, should the Fed be raising interest rates right now, as Charles Schwab said, and Mr. Malpass and Mr. Beauvais agreed with Mr. Schwab?
I think that it wouldn't hurt because you have an awful lot of people hurting from lack of income.
There's a lot of retirees really hurting.
Absolutely, very much so.
I mean, I get the emails all the Friday nights is the worst night for the emails. But the fact is, I mean, these are very trying times for savers, isn't it?
Absolutely.
What's gold going to do?
I think gold continues higher, but I think it's not necessarily an inflationary scare at all. I think it's more of a currency debasement.
Well, let's look at this chart right there. The dollar must go down. That's a Marty Feldstein chart. Margaret Brennan speaking with Professor Feldstein, and that was the typeface he used in an editorial years ago. The dollar must go down. Do you agree with Professor Feldstein? The dollar must go down?
Well, we have certainly thought since 2002 that it was in a decline, and we think that this year-plus rally trading range rally has been an interim in an ongoing decline for the dollar. And it's not just the dollar index. Actually, the dollar that we like to follow is the U.S. trade-weighted broad dollar, which on Bloomberg is USTUBROA. And that is a very interesting perspective because it includes all of our trading partners and not just the large ones. And I think the key here is the global expansion and the emerging nations. And it's those currencies that are rising against the dollar rather significantly at this point. And I think that the profile of this is a break of a 22-year uptrend.
Come on over here if you would. Let's get the camera guys over here. And here's the chart.
That's the one we like to watch.
Here's that forever strong dollar, Robert Rubin strong dollar.
Right.
Over we go.
Yep.
And here we are. And then we've got this rally. And you're suggesting we break through right there where my finger is.
And if you look at this chart, you see that you've broken a 22-year uptrend, which is a structural breakdown.
There it is.
There's a 6-year top. And this was the rally that we had last year was nothing more than a kickback rally to the breakdown, and now you're starting down again.
Should we fear this?
Well, yes,
should we fear a weaker dollar?
I think so.
Can everybody have a depreciating currency? I mean, should we fear? I mean, everybody wants a weaker currency.
That's why gold is going up.
That's why gold's going up.
That's why gold is going up.
And again, that's that cross-asset field. Yeah. Explain that. I want Louise Yamada to explain this. What is the linkage of gold to currencies and to oil?
To currencies, there's always been an inverse relationship between gold and the dollar.
Weaker dollar, higher gold. Just that simple.
Yeah. And I think now you have even a greater concern because you have so many debt-laden countries that the currencies are all depreciating versus gold.
And here we go, linking right in. Thanks, Emily. Germany should not be reducing its budget deficit. That was Mr. Soros, and of course he said that today in the FT. And you know, you see this austerity that's out there, all these interdependencies and linkages. In the blur of all your charts, what's the number one thing you're looking at right now? When you come in the morning, what's the thing you focus on first?
I look at everything. I look at the dollar.
That's not a surveillance midday answer. What's the thing you look at? The euro?
No, we look at the dollar, and we look at gold, and we look at oil.
Let's look at Goldman Sachs over here. This chart, I'm sorry, I think it's a painful chart. There's that huge rally in 06 and 07. Down we go. They recover, and they're sort of rolling over. How are the financials? How's global Wall Street doing?
The financials continue weak. They put in a major top. You had a major 10-year breakdown in the financials, and when you have a major breakdown of that sort, you're going to have a long, long time for repair. Look at American Express today. It's breaking down extremely badly.
Well, when you look at the financials and you look at the U.S. sector, let me ask you a question I asked David Malpass and Richard Beauvais. With your years at Citigroup, do you just assume that at the margin Wall Street expands abroad, or are they going to create jobs in the United States? Is the technical analysis you're doing suggesting a vibrancy to the American financial system?
No. It's not. But I think that where you are seeing the growth is global. I mean, we've been saying that since 1995. And I think that you have a two-tier market, what we've called a hybrid market environment, where the U.S. may still be in the throes of a structural bear market, notwithstanding these extremely generous rallies. But the global environment, particularly the emerging nations, not the developed nations. Your Hong Kong chart in your
research note was something.
Well, all of the emerging versus the developed nations is outperforming consistently. And we would suggest that the emerging nations are where we were in 1942, a new structural bull market.
Here's the number for the day. And, you know, you look at this number, Louise, over here on our big screen, the official surveillance midday screen, 1.8 trillion. This is out of a great Bloomberg News story. Financial company losses in the crisis were approaching 2 trillion. You know, among all the different financial companies worldwide. That's getting to be a big number, isn't it?
Very distressing.
What else are you looking at? I want to talk interest rates here in the time we've got left to do. The 2-year yield comes down. Do you have a point? I mean, some of the fundamental people have said to me 0.40 is where they think the 2-year goes to. Do you do that? Or?
I don't know. It reminds me of calculus. I had a really hard concept of understanding the approaching zero. We have interest rates approaching zero.
Calculus, the official math of surveillance midday. Yeah. Okay, keep that up. What do you see here in a 2-year chart?
For the 2-year chart, we
bond.
Yeah, we have
Did you
30
bring
in the
enough
10.
paperwork?
Yeah, I brought lots of
We're
it.
killing trees, Louise. You're supposed to do this on an iPad.
We have a target, a potential target for the 2-year at 0.3.
0.30?
0.3.
0.3.
Yeah. And but I think that the key here is that your 30-year isn't following suit. It's not following suit as much as the 10-year, and we've suggested that the 30-year may be our canary in the mine for if and when, as and when, not if, but when interest rates begin to lift. It's probably going to be because foreigners don't want our debt anymore. I think you'll see it there first.
So yeah. The 2-year can go to a 0.3. Give me a second digit. 0.33? 0.33. Are we prepared for that? Is that emotionally in the market? I don't think so.
Well, 0.4 to 0.33, it's not that far off. We know it's low. It's not helping people.
On a 2-year yield.
And, I think that a lot of what has to happen in this country is we've got to bring manufacturing back.
Okay, next time we put you on the box, next time I'll shrink. I'll get on the lower chair. I'll be like Mick Fleetwood playing at the drums with a chair barely off the ground. Okay. Thank you so much for stopping by.
My pleasure. Thank you, and congratulations on the new show.
Well, we're having fun.